Welcome everyone to our weekly market update from SC Securities. As always, we'll be looking at some of the major market news over the last week and some of the major headlines on a macro scale, whilst also delving into the secondary market and giving you all a look into the commodities and the global markets. So to start off with the Sri Lankan stock market, the all share did turn volatile this week amid adverse sentiment on macro issues. So the ASPI actually fell by 1.66% this week, whilst the S&P fell by 2.21% this week. Like I said before, the index experienced significant volatility, with the all share declining by close to 109 points on Thursday before a slight recovery on Friday. This was primarily on the back of the diversified financial industry, which fell by close to 91%, with the bulk of the fall attributable to a 25% dip in LOLC development finance, which actually witnessed its first negative close in weeks. In terms of foreign activity as well, up till today, there wasn't much really happening, except for the fact that there was some selling. And today we saw a significant bulk of selling happening. In terms of turnover as well, it is not anywhere near as high as we have experienced in the past few weeks. And this week we saw what we thought, or what we believed to be was the somewhat of a correction in the market. Now, in terms of some of the macro news that have affected this negative investor sentiment, if we delve into that, the main headline is that Fitch Rating cites that domestic banks had heightened sovereign risk. So they published a report this week citing that the domestic banks had heightened sovereign risk due to their high exposure to foreign currency denominated government securities, coupled with weaker capital positions. The report went on to further state that the domestic banks had about a third of their combined assets exposed to the central government by the end of 2020. And as such, Fitch do not rate any of the domestic banks above the sovereign's CCC local currency issuer default rating and the CCC negative score on banks' operating environment. Now, overall, this does not paint a very rosy picture, as below the CCC is what we call the junk bond territory. So this does not bode well, and it is somewhat of a black mark for the industry. In other news, the CSC and the CHEC Port City signed a memorandum, or an MOU, or a memorandum of understanding, with the objective of establishing an international multi-currency exchange within the port city. The exchange will act as a gateway for both regional and global investors. And in terms of new developments, the new SEC Act, or the Securities and Exchange Commission Act, will be presented into Parliament next week. Now, from what we're hearing, the new act will significantly enhance the powers of the SEC and auditors, and overall set a much stricter base of rules for intermediaries, whilst also providing whistleblower protection. So that means anyone who was to whistleblow on their company or companies engaging in malpractice would be protected from eviction from his or her duty. Overall, this can be seen as a positive spin, as it is actually increasing compliance within the market and actually reducing the risk of manipulation within the market, which is something that we might actually see help pick up foreign investment per se. In terms of secondary market news, it remains somewhat at a lull. We saw that there was a auction held on Wednesday, that was the 30th of June, which managed to sell 80% of the 37 billion treasury bill auction, but it was at a pre-declared price control of 5.23% for 12-month T-bills, up 0.2 basis points. But again, 20% of this auction went unsold, and this means that the central bank will have to print more money. Now, over the past 2 weeks, we have seen that over 22 billion have been printed. This week, close to 41 billion, were due to mature. However, we don't know how much of this is already held by the central bank. Now, as we've mentioned countless amount of times, this level of quantitative easing plus this failed bond auctions are putting immense pressure on the interest rate. And also this week, we saw the CCPI inflation figures out, for June, which also didn't paint a very rosy picture. We have predicted that the NCPI inflation or headline inflation will increase for June. That will be out in another couple of weeks. So all indicators point towards a revision uptick. Whether the central bank does that or not is another issue altogether. But as a key date to look out for, I believe the 8th of January is when the central bank will have its next monetary policy review. So please keep an eye out for that date. That will be a key date. I believe it is either the 8th or the 14th. But yes, it's one of those two dates. In terms of the commodity market, we've seen oil prices rise. Now they rose by more than 2% on Thursday. And this is mainly on the back of OPEC producers indicating that they would ramp up production at a slower rate in the coming months. Now we saw that effect, that having an effect on both Brent and WTI barrel prices, which went up above $75. And this is the highest since October 2018. And our outlook suggests that these prices will continue to rise. We actually have mentioned this on a few occasions. But what we now also do see is that most of these OPEC countries will be looking to make up some lost ground from the previous year due to COVID. So they were severely hampered last year, but they might actually try and control the supply so that they can continue to sell oil at high prices and actually gain more from it. Aluminium prices actually saw a rise. We saw aluminium prices actually shoot up by close to $54 per ton this week, and that is on the back of Russia's export duty impact. So last week, the Russian government introduced an export duty on most steel products, aluminium, copper, and nickel. The duty will either be at 15% of export prices or a metal-specific minimum rate. So that's still up for debate. Fitch actually did put out a report on this, where they say that they maintain that in terms of an outlook, that the duty will have a limited impact on global markets, although the steel and aluminium markets may be adversely affected in the short term. So we're already kind of seeing that with aluminium prices soaring this week. Gold continued its drop this week again, down 9.4, and that is mainly on the back of the stronger dollar following the Fed's shift in monetary policy last week, which we actually touched upon in great detail. And finally, in terms of global markets, we see that Asia markets came in mixed this week as fears of the Delta variant spreading across Southeast Asia kept investors in a very circumspect mood. It has actually forced several governments to reimpose their lockdown measures. And this has actually raised key concerns by the investors on how the recovery pace will be affected moving forward. So we saw Hang Seng and Nikkei down by 0.27% and 2.07% respectively, whilst the Shanghai Stock Exchange Composite Index and the Mumbai Sensex were up by 1.14% and 0.32% respectively. European shares climbed on Friday, driven primarily by semiconductor makers, whilst investors in Europe and US are waiting for the monthly jobs report out of the US that is due. Those are the main highlights for this week, and as always, I will now move it along to Harin, who will take over and take you through the technicals regarding the all share and our pick of the week this week, HMB non-voting. Over to you, Harin.
Thank you very much, Nuwan. So I'll be first starting off with the all share index, and this would be the daily chart of the all share index. So we were basically able to see how the index went to the resistance of 7,950, 8,000, where the index actually got rejected from 7,956.01, making a high there. So from there, we were able to see the yesterday and day before yesterday as well, there was a rapid decline in the all share index. So the index got somewhat rejected from the daily support level 7650, 700, and also making their low of 7,632.77. So currently we are in the daily support level, and it is the index closed at 7,746.56, which is above the daily support level. And looking from the moving averages, we can see that the index is actually below the 8-day moving average, which is the blue one, which is below 7,768.23. So if it comes below the daily support level, if it breaks this daily support level, we'll be able to see the index further decline into the daily support level of 7,450, 7,500, also touching the uptrend trend line. So that could be tested as well if the index continues to decline to the daily support level of 7,450, 7,500. Also, looking at the RSI, currently this RSI has come to the mid level, which is 60.84. It made somewhat around a peak of 78.58, and now it has come to the mid range, somewhat cooling down. So here, if index doesn't basically reject from this daily support of support 7,650, 7,700 and move to the 7,800, 7,850 above the EMA levels, 8 EMA level again, this could potentially indicate that there's still possibility that the index could further decline and break the daily support level 7,650, 7,700. So we currently have a structure high, the structure high 7,956.01 over here, and also we have the previous structure high, which is 7,666.01, which was actually tested again. So next, moving on to HNB non-voting. So this is the monthly chart, and also the RSI is 49.05. So we were able to see how the price actually got rejected from the weekly support level of 100, 100, 500 being the psychological area. And currently, the price is actually moving to the monthly resistance of 115, 125, and it is about both the EMA levels 18 and 8 moving averages. So basically, this could indicate that the price could actually move further to the monthly resistance 115, 125, and thereafter, if we are able to see somewhat around a breakout from this trend, declining trend, and also the monthly resistance, will be able to expect the weekly resistance of 140, 145. So adding to that, basically previously we were able to see in 2018 how the last crossing has occurred, and that was basically a bearish for trend. And prior to 2018, in somewhat around 2013, we were able to see the bullish trend occurring. So basically there was trend reversal. So there was bullish trend, and then there was a bearish trend. So once the price is actually there's actually crossing above the both EMA levels, and also once the price trades above the monthly resistance 115 and 125, will be able to see somewhat around a long-term crossing from the EMA levels as well. And this would indicate that the price would actually initially reach the weekly resistance 140, 145, and then reaching the monthly resistance 160, 170 key area. So thank you. Over to you, Nuwan.
Thanks, Harin. And as always, thank you everyone for joining in. As always, this will be made available on YouTube, and the report will be sent across via our client mail. So we look forward to having you as always again next week, and stay safe, everybody, and have a pleasant weekend. Thank you.